The price of oil dropped last year, not because the world needed less of it, not because electric cars suddenly took over, not because some new clean energy miracle appeared overnight. It dropped because a handful of men in suits sitting in a room in Riyadh decided it should. And almost nobody covered the story properly. Not the economics channels, not the financial press, not the podcasts. They reported the number. They did not explain the mechanism. They did not tell you what it means for the price of everything in your life, from the food you eat to the loan you are trying to pay off. So let us do that now. Because this is not a story about oil. Oil is just the delivery mechanism. This is a story about who controls the price of the modern world and what happens when that control starts to slip. Here is something most people do not fully appreciate. Oil is not just fuel. Oil is the substrate of the global economy. It is in the fertilizer that grows your food. It is in the plastic that packages it. It is in the ships and trucks that move it. It is in the asphalt under those trucks. It is in the synthetic fibers of the clothes on your back. When the price of oil moves, really moves, everything moves with it, with a delay, quietly, in ways that do not make headlines but show up in your grocery bill 3 months later. And right now, oil is doing something unusual, something that has not happened quite this way before. The old rules, the rules that governed how oil was priced and who had the power to set that price, are breaking down in real time. OPEC, the cartel that has controlled roughly 40% of global oil supply for decades, is fracturing. American shale production has turned the United States into the world's largest oil producer, a fact that would have seemed impossible 15 years ago. The clean energy transition is creating a new kind of uncertainty that no previous oil cycle has had to navigate. And sitting underneath it all is a question that no economist has cleanly answered. What happens to the world economy when no one is actually in charge of oil anymore? To understand the shock, you first need to understand the machine. For most of the 20th century, oil was priced by a small group of producing nations organized into a cartel called OPEC, the Organization of the Petroleum Exporting Countries. Founded in 1960, it included Saudi Arabia, Iraq, Iran, Venezuela, and a few others. The idea was simple. If you control the supply, you control the price. And it worked, spectacularly. The 1973 oil embargo, when Arab OPEC members cut off supply to the United States and Western Europe over the Yom Kippur War, caused the first modern oil shock. Prices quadrupled in months. American gas stations ran dry. People waited in lines for hours. The global economy contracted. Inflation exploded. The world learned, in the most painful way possible, how much everything depended on oil. After 1973, the relationship between oil producers and oil consumers became one of the defining geopolitical fault lines of the modern era. Saudi Arabia became extraordinarily powerful, not because of its military, not because of its culture, but because it sat on the largest conventional oil reserves on the planet and was willing to use them as leverage. The mechanism is not complicated. OPEC meets, usually twice a year, and its member nations agree on production quotas. Less supply, higher price. More supply, lower price. The cartel acts as a governor on the global economy, deciding collectively how much financial pressure to apply to every country that runs on oil, which is every country. For decades, this system held more or less together. There were cracks. OPEC members cheated on quotas constantly, every economist will tell you. But the system functioned well enough to keep prices in a range that the cartel found acceptable. Then came shale. In the early 2000s, American engineers figured out how to extract oil from a type of rock formation called shale, rock that was previously considered impossible to drill economically. The technique is called hydraulic fracturing. Most people call it fracking. It was not an overnight revolution. It was slow, And then it was sudden. By 2018, the United States had surpassed Saudi Arabia and Russia to become the single largest oil producer in the world. A country that had spent decades worried about energy dependence, that had fought wars partly over oil access, was now producing more oil than anyone on the planet. OPEC had a problem it had never faced before, a competitor it could not control. Saudi Arabia's traditional strategy, cut production, raise prices, discipline the market, no longer worked cleanly. Because every time Saudi Arabia cut supply and prices rose, American shale producers turned their wells back on. Shale production has a quality that conventional oil does not. It can be turned on and off relatively quickly. It responds to price signals like a business because it is a business, not a state-controlled operation, but thousands of independent companies making individual profit calculations. The result is a new and deeply unstable equilibrium. When oil prices are high, American shale expands, flooding the market, pulling prices back down. When prices fall too low, shale producers go bankrupt, as hundreds did during the 2020 crash, taking supply offline, allowing prices to recover. The market oscillates. Nobody is fully in control. And here's the part that does not get discussed enough. Saudi Arabia knows this, and Saudi Arabia is scared, not of American military power, not of sanctions, but of something far more threatening to a nation whose entire economy runs on oil revenue. The possibility that oil demand might peak, and soon. Saudi Arabia's entire social contract runs on oil money. The Saudi government does not tax its citizens in any meaningful way. It provides housing subsidies, fuel subsidies, government jobs, and social services, all funded almost entirely by oil revenue. The royal family maintains its grip on power in part by ensuring that the population is comfortable enough to not ask difficult questions. The International Monetary Fund has estimated that Saudi Arabia needs oil to trade at roughly $80 to $90 per barrel to balance its national budget. When oil falls below that level, the government runs a deficit. It burns through its foreign reserves. It borrows. And electric vehicles are an existential threat to that number. Not tomorrow, not next year, but the trajectory is clear. Global electric vehicle sales are growing at roughly 30% annually. Every EV sold is a car that will never buy gasoline. Every percentage point of global car sales that shifts to electric is a permanent reduction in oil demand that no production cut can compensate for. The irony is almost too neat. Saudi Arabia is rushing to build a post-oil economy, investing in tourism, technology, entertainment, while simultaneously needing oil prices to stay high enough to fund that transition. It needs to sell as much oil as possible right now at the highest possible price before the window closes. Which means every OPEC decision from this point forward is not just an economic calculation, it is a race against time. And the rest of the world, every country that imports oil, every business that depends on stable energy costs, every central bank trying to control inflation is strapped into a vehicle whose driver has a very different destination in mind. Now, you might be thinking, surely this is fine. We are transitioning to clean energy. Solar is cheap. Wind is expanding. The problem solves itself. And there is truth in that. Renewable energy is genuinely the fastest-growing energy source in human history. The cost of solar power has fallen by 90% in the last decade. That is a real and remarkable thing. But here is what the green energy narrative tends to leave out. The world currently consumes roughly 100 million barrels of oil per day, not per year, per day. And global energy demand is still growing, driven by India, Southeast Asia, and Africa, where hundreds of millions of people are entering the middle class and consuming energy for the first time. The International Energy Agency, not an oil company, not a Saudi think tank, the IEA has said clearly that even in its most optimistic clean energy scenario, the world will still need significant oil supply through 2040. The transition is happening, but it is happening slowly. And in the gap between the world we have and the world we want, oil prices will continue to affect everything. There is also a subtler problem. The infrastructure for clean energy, the solar panels, the wind turbines, the EV batteries, the electrical grid upgrades, requires enormous quantities of steel, copper, lithium, and other materials. Producing and transporting those materials requires energy. Right now, much of that energy comes from oil. The green transition in its early stages actually increases demand for the fossil fuels it is trying to replace. This is not a reason to abandon the transition. It is a reason to understand that energy systems do not change overnight, and anyone telling you otherwise is selling something. Let us bring this home. When oil prices rise unexpectedly, central banks face an impossible choice. Higher oil prices push inflation up. To fight inflation, central banks raise interest rates. Higher interest rates slow borrowing, slow investment, slow economic growth. Businesses hire less, loans become more expensive, mortgages climb. The cost of everything financed by debt goes up. This is called an oil price shock, and the world has been through several of them. 1973, 1979, 1990, 2008. Each one reshaped the global economy in ways that took years to fully play out. The current situation is different from all of those, and in some ways more dangerous, because it is not one shock. It is a slow-motion structural destabilization. OPEC is weaker than it has ever been. American shale introduces a new volatility. The clean energy transition creates demand uncertainty over a 20-year horizon. Russia's war in Ukraine removed a major energy supplier from the European market almost overnight. China's economic reopening and slowdown cycles now move oil prices in ways that were not possible 15 years ago. The system has more moving parts than it has ever had, and more moving parts means more ways for something to break. There is a concept in systems engineering called brittleness. A system becomes brittle not when it is under stress, but when it has lost its ability to absorb stress without breaking. The global oil market is showing signs of that brittleness right now. Small supply disruptions, a conflict in the Middle East, a hurricane in the Gulf of Mexico, a political crisis in Libya are producing larger price swings than they did a generation ago. And those price swings transmit, with varying delays, into the price of everything you buy, everything you borrow, and every decision your government makes about how to spend its money. So here is where we are. The old oil order, OPEC setting prices, producing nations holding the lever, consuming nations accepting the terms, is dissolving. Not collapsing overnight, dissolving. Slowly, quietly, in a way that the daily news cycle is not structured to cover. In its place is something messier, a market with more producers, more volatility, more geopolitical complexity, and a looming question about whether peak demand is 10 years away or 30. Saudi Arabia is racing to reinvent itself before the revenue runs out. American shale producers are calculating whether to drill more or hold back and wait for prices to rise. Central banks are modeling oil price scenarios into their inflation forecasts, and governments from Brussels to Beijing are betting that clean energy will arrive fast enough to change the equation before the next major shock hits. All of those bets might be right, or none of them might be. Here is the question worth sitting with. The world spent the last 50 years arguing about who controls oil. The next 50 years will be spent arguing about something far more fundamental: who controls the energy that replaces it, who pays for the transition, and who gets left behind in the gap. That argument has already started. Most people just do not know it yet. And the ones who understand the mechanism, who see the system clearly before the headline arrives, will be better positioned for whatever comes next.
Hey everyone! Please subscribe to the channel for more videos. It's free and you'll get updates on new content. Thanks for watching.